At exactly 9:23 a.m. Beijing time on December 26, 2025, a single number appeared on trading screens across the Shanghai Gold Exchange that made every major bullion dealer in the world stop breathing: $81.99 per ounce. This was not a price for futures contracts. This was not for paper derivatives or digital IOUs. This was the price for physical silver in your hand, deliverable today. At that exact same moment in New York, the COMEX spot price read $79.57. This created a $2.42 gap between the East and the West. In the world of high-frequency trading and global arbitrage, a premium of this magnitude represents the most significant pricing disconnect in the history of modern commodity markets. Under normal circumstances, such a gap would be closed in milliseconds by traders buying in New York and selling in Shanghai. But on this morning, the machine stayed silent. This was not a glitch. This was not a temporary market inefficiency. This was the precise moment the global financial system realized that China had just killed the silver market as we know it. We are now standing in a critical window of time with only 4 days left before the final execution is complete. This is the unfolding story of January 1st, 2026. It is the day the world will wake up to discover that the most critical industrial metal on the planet can no longer move freely across borders. Silver is the substance that powers your solar panels, your electric vehicles, your smartphones, and your artificial intelligence data centers. It is the most conductive element on Earth, and as of this moment, the primary source of its refined supply is being locked behind a great wall of regulation. By the time you finish listening to this analysis, you will understand why the next 96 hours will determine whether you are positioned on the right side of the largest commodity revaluation in 50 years. We are witnessing the death of the paper price and the birth of a physical reality. For decades, the West has controlled the price of silver through massive leverage and digital contracts. But China has just flipped the switch. They have realized that in a world of accelerating technological warfare and energy transition, holding the physical metal is infinitely more valuable than holding a promise of payment in a depreciating currency. Let me take you back 8 weeks to late October 2025. Silver was trading at $52 per ounce. At the time, that felt like a peak. It represented a 79% gain from the start of the year. While retail investors were cheering, the people who moved billions of dollars inside the vaults in London and the trading floors in Chicago were terrified. They saw something coming that the mainstream media refused to report. They saw the end of the float, the end of liquidity, and the beginning of a structural shortage that no amount of money printing can fix. To understand why the global silver market is currently in a state of cardiac arrest, we must look at a single-page document issued on October 30th, 2025. The Chinese Ministry of Commerce released what is now known as Announcement Number 68. To the casual observer or the mainstream financial press, it looked like standard bureaucratic paperwork. They ignored it. But to those who understand the plumbing of the global commodity trade, it was a declaration of war. The announcement stated that effective January 1st, 2026, all exports of physical silver from the People's Republic of China would require individual government licenses. Notice the wording carefully. This is not a quota system where a certain amount is allowed out each year. This is not a simple export tax designed to raise revenue. This is a licensing regime. It means that the Chinese government now decides on a case-by-case basis exactly who gets to receive silver and who does not. Let us break down why this is a catastrophic event for the Western financial system. China controls between 60 and 70% of the world's refined silver supply. Many people confuse mining with refining. While Mexico and Peru are massive miners of raw silver ore, China is the world's refinery. They have spent the last 40 years building the industrial infrastructure to turn raw ore and industrial byproducts into the pure .999 silver bars required by manufacturers and mints. Every year, approximately 15,000 metric tons of silver flow through Chinese refineries. Of that total, roughly 6,000 tons are exported to the rest of the world. Those 6,000 tons represent the float. They are the essential buffer that keeps the global market functioning. London gets its silver from China. India gets its silver from China. The United States electronics industry depends on a constant stream of refined silver from Chinese ports. On January 1st, that tap will be turned over to the total discretion of the Chinese Communist Party. When the announcement first hit the wires in late October, the initial market reaction was strangely muted. Silver rose $3 in a single day and then pulled back. Analysts from major Wall Street banks published notes claiming this was merely a negotiating tactic. They called it a bargaining chip in the ongoing trade war. They assured their clients that licenses would be issued freely to maintain market stability. They were dead wrong. By mid-November, the first real-world reports began to emerge from the industrial hubs of Shanghai and Shenzhen. Refineries that had exported silver to the West for decades were being told that their applications for 2026 licenses were under review indefinitely. Small and medium-sized exporters were being shut out of the system entirely. Only the state-owned giants, the companies with direct ties to the Ministry of Commerce, were receiving preliminary approvals. Even these approvals came with draconian conditions. Exporters were told they could only ship to approved countries and only for approved end uses. Every single shipment must be reported to the central government within 24 hours. This is not a regulatory update. This is a strategic choke point. China has realized that silver is too important to be traded freely on Western exchanges at prices they deem too low. They are locking the door, and they are doing it with surgical precision just as the world needs the metal most. To truly grasp the gravity of the situation, we must look beyond simple mining statistics. While the world focuses on silver mines in Mexico or Peru, the real power lies in the process of refining. China has quietly and systematically built a near monopoly on the production of investment-grade silver. According to recent industrial data from late 2024 and early 2025, China controls between 60 and 70% of the global refined silver supply. This is the silver that ends up in the world's most critical supply chains. The global silver market operates on a razor-thin margin of physical availability. Every year, approximately 15,000 metric tons of silver flow through Chinese refineries. Of this massive volume, roughly 6,000 tons are exported to international markets. These 6,000 tons are not just a statistic. They are the vital float that keeps the global commodity engine from seizing up. London, the world's primary spot trading hub, relies on this steady stream from the east. India, the second largest consumer of silver, depends on Chinese bars to feed its jewelry and industrial sectors. The United States, despite being a major financial power, relies on Chinese imports for a substantial portion of its refined silver needs. On January 1st, the Chinese Communist Party effectively gains the power to turn that tap off at will. The move toward a licensing regime is a masterclass in resource nationalism. By moving away from a predictable quota system to a case-by-case approval process, Beijing has created a landscape of total uncertainty. For the Western manufacturer, this means that the silver needed for next month's production run is no longer guaranteed by a contract. It is subject to the political whims of a foreign power. When we examine the numbers, the potential for a global deficit is staggering. Industry experts were already projecting an annual silver deficit of over 2,500 metric tons due to the explosion in green energy demand. If China restricts its 6,000 tons of exports by even 50%, that deficit could instantly double to 5,000 metric tons. There is no other source on the planet that can fill a gap of this magnitude. Latin American producers in Mexico and Peru are already operating near their maximum theoretical capacity. Even with massive investment, it would take 3 to 5 years to build the refining infrastructure necessary to replace what China currently provides. In the world of high-tech manufacturing, 3 years is an eternity. Without silver, the assembly lines for solar panels in Europe stop. The production of advanced semiconductors in the United States slows to a crawl. The silver market is not just a place for speculators to play, it is the foundation of the modern industrial world, and that foundation is being pulled out from under the West. As the physical silver market in China began to tighten in late 2025, the effects were felt almost immediately on the trading floors of the West. On November 28th, which was Thanksgiving Day in the United States, silver broke the $60 per ounce barrier for the first time in human history. But something strange happened during that historic breakout. The COMEX, the exchange in New York that sets the benchmark price for North America, experienced what they officially called a cooling system malfunction. Trading was halted for 6 hours. 6 hours in the middle of a global supply crisis. For those who understand how modern financial markets are built, this explanation was impossible to swallow. These exchange systems are designed to survive cyber attacks, power grid failures, and even kinetic warfare. They do not simply fail because of a cooling issue on the most volatile trading day of the decade. People who work inside these institutions know the truth. A 6-hour halt during a delivery squeeze is not a technical issue. It is a controlled intervention. It was a desperate attempt to prevent a cascade of liquidations that could have bankrupted several major bullion banks in a single afternoon. When the markets reopened, the message was clear. The exchange was struggling to maintain the illusion of price discovery. This is because the global silver market is not a single entity. It is a two-tiered system. On one level, you have the physical market where actual bars of silver are moved from refineries to vaults. On the other level, you have the paper market, where trillions of dollars in derivatives are traded every year. The problem is that the paper market has grown so large that it has completely swallowed the physical reality. For every 1 ounce of physical silver sitting in a registered vault, there are over 200 paper claims on that same ounce. As long as only a few people ask for their metal at the same time, the system works beautifully. It creates the illusion of deep liquidity and stable prices. But when China announced its export restrictions, the owners of those 200 paper claims all looked at the same vault at the same time, and they realized the vault was nearly empty. Between June 2022 and December 2025, the silver stocks held by the London Bullion Market Association fell from over 31,000 metric tons to less than 20,000. The float was disappearing. When lease rates, the cost of borrowing silver overnight, spiked to 8% in December, it confirmed the worst fears of the market. There was no silver left to borrow. The ghost in the machine had been exposed. The paper price was no longer a reflection of value. It was merely a desperate mathematical formula trying to cover up a physical void. To understand why China is willing to risk a global financial firestorm, you must understand that they no longer view silver as a luxury or a simple investment. They view it as a strategic survival asset. Silver is the most conductive element on Earth. It is more conductive than copper and more conductive than gold. In the age of the green energy transition and the artificial intelligence revolution, this makes silver irreplaceable. Each high-efficiency solar panel requires approximately 20 grams of silver paste to create the conductive pathways for electricity. As we move into 2026, China is in the process of building 700 gigawatts of solar capacity. That single goal requires billions of grams of silver. China already produces 90% of the world's solar panels. By restricting exports of refined silver, they are ensuring that their own factories have a guaranteed supply at a lower domestic price, while their competitors in Europe and North America are forced to bid for whatever remains at astronomical premiums. The same logic applies to the automotive industry. China is now the undisputed global leader in electric vehicle production. A traditional internal combustion engine vehicle uses between 15 and 28 grams of silver. An electric vehicle, however, uses between 25 and 50 grams. This represents an increase of 67 to 79%. Companies like BYD are currently researching silver-based solid-state batteries that could push those requirements even higher. China produces 60% of the world's electric vehicles. They have made a calculated decision that their domestic technological dominance is far more important than supplying the global bullion market. This is resource nationalism in its purest form. It is the exact same strategy that China used with rare earth elements in the early 2010s. They cut off the supply, watched the global prices explode, and waited for the rest of the world to scramble. By the time other nations could even begin to build their own supply chains, China had already secured its position as the world leader in the end products. We are also seeing a massive surge in demand from the artificial intelligence sector. Every AI data center, every high-speed processor, and every advanced sensor relies on silver for its superior electrical and thermal conductivity. As the world races to build out AI infrastructure, the demand for silver is becoming decoupled from the traditional economic cycle. Even if the global economy slows down, the hunger for silver from the tech and energy sectors continues to grow. China has seen the math. They know that there is not enough silver for everyone to achieve their climate and technology goals. By implementing announcement number 68, they have simply decided that they will be the ones who reach the finish line first, while the rest of the world watches from a distance. The silver market is currently the site of a silent but violent war between two irreconcilable forces. On one side, you have the digital financial system of the West, built on leverage and promises. On the other side, you have the physical reality of the East, built on refined metal and industrial dominance. To understand how we reach this breaking point, you must understand the mathematics of the paper price. In a normal year, the total amount of silver mined globally is approximately 1 billion ounces. After you subtract the silver consumed by industry, jewelry, and silver paste for technology, only about 500 million ounces are left for investment demand. However, the total volume of silver traded on the COMEX and other derivative exchanges every year exceeds 100 billion ounces. This means there are 200 paper ounces trading for every 1 physical ounce that actually exists in a vault. This 200-to-1 ratio is the foundation of the modern pricing system. It is a system designed to create the illusion of infinite supply. As long as the holders of those 100 billion paper ounces are content to settle their trades in cash, the music keeps playing. But in late 2025, the music stopped. When China announced its export restrictions, the major industrial buyers and sovereign wealth funds realized that a cash settlement cannot build a solar panel or a cruise missile. Only physical metal can do that. Suddenly, the ratio shattered. Instead of 1 out of 200 people asking for delivery, we saw 10 out of 200, then 20, then 50. The vaults in London and New York began to empty at a rate never seen in the history of the precious metals markets. This is why the price in Shanghai is trading at such a massive premium over the price in New York. The East is already pricing silver based on its physical scarcity, while the West is still trying to defend a paper price that has no metal behind it. This is not a market failure. This is a design failure. The exchange system was never built to actually deliver metal to everyone who holds a contract. It was built to suppress price volatility through the creation of infinite digital supply. But you cannot print silver. You cannot create 1 billion ounces of silver with a keyboard stroke at a central bank. When the physical supply chain breaks, as it has now with China's move, the paper system goes into a death spiral. We are now witnessing what economists call a force majeure event. This is when an exchange admits it can no longer fulfill its obligations. We have already seen the 6-hour halt on the COMEX. We have seen dealers in London refusing to quote prices for large orders. This is the moment when paper and physical finally separate forever. The people who hold paper contracts will be offered cash settlements at prices determined by the very banks that are failing. The people who own the actual metal will be the only ones left standing. As we approach the end of December 2025, the silver market has moved beyond a simple supply squeeze and into the realm of geopolitical warfare. On December 10th, reports began to surface on private trading desks about a massive, unfilled order that has sent shockwaves through the global bullion banking system. Rumors suggest that a major hedge fund, linked by several sources to the legendary macro investor Paul Tudor Jones, placed an order for 12,400 metric tons of physical silver. To put that number in perspective, 12,400 tons is more silver than currently exists in all the registered COMEX vaults in New York combined. The order was not for silver futures or paper ETF shares. It was for physical delivery in late December and early January. The instructions to the brokers were reportedly simple: acquire the metal at any price before the Chinese export licenses take effect. When the brokers went to London, they were told there was no available inventory. When they went to Zurich, they received the same answer. When they finally turned to New York, the exchange offered futures contracts, but stated that physical delivery would take at least 6 to 8 weeks, well past the January 1st deadline. That unfilled order now hangs like a sword over the throat of every bullion bank on the planet. It proves that at the highest levels of global finance, the smartest money is no longer betting on a price increase. They are betting on the total disappearance of physical supply. While individual billionaires scramble for metal, a much larger move is happening at the sovereign level. On October 31st, the BRICS Alliance officially launched the pilot phase of a new trade settlement instrument known as the unit. This is a blockchain-based system designed specifically to bypass the United States dollar. Most importantly, the unit is backed 40% by physical gold and 60% by a basket of local currencies. The implications for silver are profound. As gold is remonetized by the nations representing 45% of the world's population and 36% of global GDP, silver naturally follows. Russia and China have already bypassed the dollar in 95% of their bilateral trade. Now they are creating a system where silver is no longer just an industrial commodity, but a strategic reserve asset. In November, it was reported that Russia purchased $1 billion worth of gold and silver from China in a single transaction. These nations are moving their wealth out of paper promises and into the only assets that cannot be frozen, seized, or printed into oblivion. We are witnessing the birth of a new commodity-backed reality, and silver is at the very center of the storm. To understand where the price of silver is truly headed, we must analyze its relationship with gold. Historically, the gold-to-silver ratio has served as a master compass for precious metals investors. This ratio measures exactly how many ounces of silver it takes to purchase one single ounce of gold. Throughout most of human history, from the Roman Empire to the 19th century, this ratio was remarkably stable at approximately 15-1 or 16-1. However, in the modern era of paper currencies and digital trading, the ratio has experienced wild and extreme swings. On December 26, 2025, gold reached an all-time high of $4,532 per ounce, marking a gain of nearly 73% for the year. This represents the strongest annual performance for gold since 1979. Silver, meanwhile, has performed even better, surging 155% year-to-date. At the start of 2025, the gold-to-silver ratio sat at 90-1. As of today, it has compressed dramatically to 57-1. This compression is a classic signal of a major silver bull market. In every historic precious metals rally, gold leads the way, but silver eventually accelerates and catches up with a much higher velocity. When the ratio falls, it means silver is outperforming gold and reclaiming its historical value. Let us look at the historical extremes to find a target for this move. In 1980, during the peak of the Hunt brothers silver squeeze, the ratio briefly touched 17-1. If that level were achieved today with gold at $4,500, the price of silver would reach $264 per ounce. Even a more conservative ratio of 35-1, which the market reached during the 2008 financial crisis, would put silver at $129. $129 is a number that is now appearing in numerous institutional reports. While some banks remain cautious, others have completely revised their outlooks based on the Chinese export restrictions. Bank of America recently raised its peak target for 2026 to $100 per ounce. BNP Paribas has also forecasted that silver could hit triple digits before the end of next year. Independent analysts are even more aggressive. Some are calling for a range of $200 to $300 per ounce within the next 6 to 12 months. These are no longer fringe voices. These are professional market strategists who realize that the current supply deficit is not temporary. It is structural. The price of silver has to rise to a level where industrial demand is destroyed or where new supply is incentivized to come online. Since it takes years to build a new silver mine or refinery, the only variable that can change in the short term is the price. We are moving toward a historic mean reversion where silver will no longer be the cheap cousin of gold, but a strategic asset valued for its extreme scarcity and essential utility. As we enter the final stretch of December 2025, the global silver market is no longer functioning according to the laws of traditional economics. It is operating under the laws of a high-stakes countdown. We have exactly 96 hours until January 1st, the moment when China's export licensing regime officially takes effect. What happens in this window of time will likely be remembered as the most violent period of price discovery in the history of commodities. The timeline is already set. On December 28th, the final full business day before the New Year holiday in China, we expect a massive wave of activity on the Shanghai Gold Exchange. Industrial buyers and large-scale speculators who have the logistical capability to pull physical metal out of Chinese vaults will be making their final moves. This is expected to push the Shanghai premium, the gap between the price in the East and the West, to even more extreme levels. We could see silver trading at $90 per ounce in Shanghai while New York struggles to stay below $80. On December 29th and 30th, Western markets will be exceptionally thin. Trading desks in London and New York are typically staffed by skeleton crews during the holidays. This low-volume environment is a recipe for extreme volatility. In a thin market, it does not take a billion-dollar trade to move the needle. A single large buy order from a panicked solar manufacturer can cause the price to jump by $5 or $10 in a matter of minutes. The market will skip over price levels entirely. creating a series of gaps that technical traders call a vacuum. Then comes January 1st. The licensing regime becomes active. In practice, this means every ounce of silver intended for export must now wait for a government official in Beijing to sign off on an application. The Ministry of Commerce has up to 30 days to review each request. For at least the first month of 2026, the flow of Chinese silver to the rest of the world could effectively drop to zero. On January 2nd, when global markets reopen, the first thing every trader on Earth will do is check the opening price in Shanghai. If that price has gapped up significantly while the West was closed, the COMEX in New York will be forced to catch up instantly. This surge will trigger thousands of automatic stop-loss orders from traders who were betting on a price correction. As these sell orders are hit, they turn into market buy orders, creating a self-reinforcing spike. We could see the price of silver move from $79 to $100 in a single trading session. This would not be driven by new buyers, but by the total failure of the market structure to provide liquidity. The final 96 hours are not just a countdown to a new year. They are a countdown to the moment the physical reality of silver finally breaks the paper chains of the global financial system. We are now standing at the threshold of a fundamental transformation in the global financial order. As of today, December 27th, 2025, silver is trading at $79.57 per ounce, having delivered a staggering 170% return since the start of the year. But the price you see on your screen is quickly becoming secondary to a much more brutal question: can you actually get the metal? For the last 50 years, since the United States officially ended the gold standard in 1971, the world has operated on the premise that currency is backed by nothing but government promises. In that system, commodities were merely things to be traded on paper to generate more currency. But as we head into 2026, that logic is reversing. We are entering a period where currency is becoming the promise, and the physical commodity is the only true reality. China has clearly seen the writing on the wall. By implementing announcement number 68 and locking down 60 to 70% of the world's refined silver supply, they are moving away from a debt-based monetary system and toward a resource-based strategic reality. They understand that you cannot print silver to power a solar grid, and you cannot conjure silver with a central bank keyboard to build an electric vehicle fleet. In a world of accelerating technological competition and energy transition, the nation that holds the physical atoms will always hold more power than the nation that holds the digital bits. This transition is what experts call a remonetization of precious metals. We are seeing it in the group's move toward a gold and local currency basket for trade settlement. We are seeing it in the massive drawdown of silver from the London and New York vaults. And we are seeing it in the premiums, those $2.42 gaps between the East and the West, which prove that the paper price is losing its ability to control the physical world. Here is the cold hard truth. If you own physical silver today, do not be distracted by the daily volatility or the potential for technical flash crashes in early January. The value of your silver is not determined by an algorithm in Chicago. It is determined by its absolute scarcity and its essential role in the modern world. If you do not yet own silver and are planning to buy, you must accept that the era of cheap, easily accessible metal is over. You may pay $80, $90, or even $100 per ounce in the coming weeks, but that premium is the price of certainty in an uncertain world. The door is closing. In less than 4 days, the global silver market will lose its primary source of supply, and the transition from paper promises to physical assets will accelerate. This is not just a trade, it is a structural break. The people who recognize this shift and position themselves accordingly will be the ones who preserve their wealth and their sovereignty in the decade to come. The question is no longer about the price per ounce. The only question that matters now is, do you have the metal before the shutdown? Welcome to the new reality.